Hello, everyone, and a very warm welcome to iFast Financial India's Invest Globally and Profitably 2021. We've been very excited to bring you India's first conference on global investing via mutual funds. And I promise you that by the end of this event, you will be all set to benefit from the best investment opportunities around the world. My name is Dipali, and I will be your host through today and tomorrow. Now, before we begin, there are a few important announcements. I would like to draw your attention to some of the cool features of our event platform. There are a couple of buttons at the bottom of your screen that you can use to interact with us, be it in terms of asking questions to the speakers or responding to polls. From our lobby, you can access our sponsor exhibits where you will find some very interesting videos, brochures, and presentations on the products that we will be discussing today. Importantly, all of our attendees who are certified financial planners and certified wealth managers uh, can claim learning credits for all the sessions that they attend with us. So do stay tuned. Now, with the important announcements out of the way, let's get back to the Power Pack sessions we have planned for you. We start off with an introductory video of iFast Financial. Yes, by we now have a welcome address by our group CEO, Mr. Lim Chang Chun, who's joining us live all the way from Singapore. Mr. Lim Chang Chun.
Thanks, Dipali. Hi, everyone. Welcome to the iFast Invest Globally and Profitably Conference 2021. The words invest globally and profitably is actually part of our mission statement. We founded the company in Singapore over 20 years ago, in the year 2000. Our mission since then has been to help our customers gain a global perspective in finding investment opportunities. We started a business in Singapore, and maybe it's easier for Singaporeans to think about investing globally because we're such a small country. But over the years, we saw very clearly that investing with a home bias, meaning that you invest mainly in the securities of your own country, was never a wise thing to do, regardless of where you come from. There's a world of highly profitable investment opportunities out there that you'll be missing out on. This thinking is increasingly true in today's world, whereby the internet is reshaping the global business landscape in an unprecedented manner. Tech giants today are the biggest, the strongest, most competitive companies in the world. And you find that they may not be coming from the various emerging market that you're currently in. It's no longer clear that emerging markets will grow faster than developed markets. Global competitiveness of the companies you invest in is becoming increasingly crucial. I'm sure the speakers at this conference will give you plenty more of pointers about this thinking over the course of the next 2 days. It used to be a challenging thing to invest globally, but now with the internet and with regulators easing on capital controls, it's become much easier. At iFAST, our main business is operating an investment platform that provides global products, administration, technology, research, compliance, and payment services to investment advisors. This so that investment advisors can focus on helping their clients invest profitably without all the hassles of the backroom work associated with it. iFAST Financial has been operating in India for almost 13 years. We might have been a bit early coming into India 13 years ago because our services did not quite fit the requirements of industry at that point in time. But we stayed on because we believe it's important to demonstrate our commitment to India. Now, I think that things are getting more exciting here with the introduction of the RIA regulations, as well as the increasing awareness of investing globally, which both fit in perfectly with the services that we provide. As the Indian investment industry increases in sophistication as well as opportunities from here, we hope to be a key partner to you in the growth of your investment advisory business, and also to your client, as they find profits in investing all over the world with your help. I wish all of you an insightful 2 days at this conference. Thank you.
Thank you so much, Changchun. It's always a pleasure hearing from you. Now, did you know, ladies and gentlemen, that investments by Indians in global mutual funds have gone up by 244% over the last 2 years? As our CEO said, things are only starting to get exciting here. And whether you have already been investing in global funds or are just starting out, it is absolutely critical that you get a firmer grip on the concepts involved. Now, on day one today, we will be covering the outlook on global markets as a whole, and we also have a few focus sessions on US markets. On day two, we will be looking at emerging markets and other developed markets like Japan and Europe. This brings me to our keynote session, where we asked our first important questions. Why global investing? And does it really help us to manage risk and returns better? In fact, ladies and gentlemen, this is also our very first poll question. Please do use the poll button at the bottom of your screen and do give us your responses. We will play the results after our keynote session. Now, coming back to our keynote, we are very fortunate, ladies and gentlemen, to have with us Gavin Schroders, Investment Director for International and Global Equities from Schroders PLC, joining us all the way from London. Gavin has over 35 years of experience managing international, global, and thematic funds. Welcome, Gavin. We're very, very lucky to have you with us today.
Thank you, Dipali. And I'm delighted to be here today, albeit virtually. It's an unfortunate consequence of stance that we are having to speak virtually. And unfortunately, it looks as though this situation will persist for some time. But I'm delighted to be opening the session, and I'm very interested to see the poll results afterwards. I've been tasked really with the job of describing the role of global equities in the context of the current market environment. And of course, the current market environment continues to be influenced significantly by the COVID virus, both in terms of the ongoing impact that the virus is having on economic activity, and growth forecasts, but increasingly the way we are also trying to understand the path for recovery as certain economies move out of lockdown and we start to see some normalization in economic activity and growth. I'll spend a little bit of time later on just explaining how we're positioned within our global equity portfolios to manage the ongoing near-term risks of the COVID crisis, but also to ensure that we are well positioned to benefit as we start to see an improvement in the level of economic activity that we expect over coming months. But I also want to spend a bit of time as well talking about global equities in the context of some of these long-term structural investment themes that are increasingly important to the way that investors think when they are allocating capital, building client portfolios. Many of these long-term structural themes are global in nature, and it's absolutely critical and central to have a global view of the world in order to navigate those themes properly and really exploit the alpha potential that can be derived from some of these themes. So I'll spend a bit of time maybe highlighting a couple of areas that I think will be interesting for you later on. Before though we start to look at the current environment and how we're positioned, I wanted just to step back for a minute, just to remind ourselves of the role that an allocation to global equities can play alongside your domestic equity exposure. I know you'll be very familiar with many of the arguments for why a global allocation to equities makes sense, and people like myself are very well rehearsed in terms of extolling the virtues of allocating to global equities. In its simplest form, a global equity allocation simply expands the investment opportunity set. It provides opportunity to gain different exposures to company with different industry characteristics, with different exposures to the economic cycle, and also with different factor characteristics. That ability to diversify some of those factor exposures is really at the heart of the value of allocating to global equities or existing domestic equity allocation. The ability to diversify across factors, whether that be across geographic regions or factors, gives you the ability to improve the risk-adjusted return of your client portfolios. And I don't think we should lose sight of that from a fundamental, but also that ability to diversify risk, different exposures is ever more important as we start to emerge from the COVID crisis. The COVID virus is going to be with us for some time to come, and that could extend months or even years, and different economies to be managing the impact of the virus at different points in time. And therefore the ability to flex your portfolio to move away from certain markets that are feeling the adverse effects of the virus at one point to economies that are perhaps better positioned provides a significant advantage over and above a strategy that is much more narrowly focused within a single country or region. So it is absolutely vital, both from a point of view of improving the risk-adjusted return potential, but also navigating what is and will remain a particularly challenging environment for the foreseeable future. For us as global investors, though, I just want to be clear, it is not simply a function of allocating from the top down to our preferred region or countries. As global investors, we see it as an opportunity to identify the best companies within their respective sectors or industries, and to have those fully represented within the portfolio without being constrained by geographic location, market of listing or domicile. Increasingly, a company's market of domicile or market of listing is largely irrelevant and tells little about the source of revenue and earnings generation that you are trying to exploit as an investor. Being liberated and being able to expand your investable universe to find those great companies and bring them into a portfolio really puts us in a position where we should be driving higher returns in light of that increased flexibility. So I want to just really now to maybe look at the current market environment and also show you how we are currently positioned in order to try to benefit from, as I say, the expected recovery, but also provide some ballast in case we see the negative effects of the virus really to some of that recovery potential. So if we look at the market environment, I think what we have seen over the last 3 months or so across markets is a change in the market environment. The market environment has changed really since November of last year, and we can date that almost precisely to the date when Pfizer announced the vaccine results, which really changed the psyche of the market and saw the characteristics that previously had been rewarded by the market over the prior 9 months really starting to underperform as the market rotated out of quality growth defensive characteristics into more cyclically orientated and higher risk characteristics. So really since November we have seen a significant rotation towards risk and cyclicality, which is really reflecting an increasingly optimistic view about the potential for recovery. Now, there still is some uncertainty about the path for recovery, and if you look at economists' forecasts, there is today a wide degree of variation across those forecasts for growth over the next 12 months. And that still reflects to a degree concern about the efficacy of the vaccines, particularly with the emergence of some of these new variants, but also vaccine delivery, given that we are still seeing delays in the availability and supply of vaccines due to problems in terms of capacity for the production of those vaccines. So that really signals a degree of caution. But on the optimistic side, the most bullish forecast view that we will see herd immunity at some stage in the second half of this year, and that really drives you that we will see a very significant rebound in activity, a once-in-a-generation rebound of activity. And if that is the case, we need to be well positioned within our portfolios to ensure that we have exposure to companies with strong operating leverage to an upcycle. If we think about then the elements of that growth surprise that we are anticipating, we need first and foremost to look at industrial activity. And industrial activity was significantly negatively affected through calendar year 2020 as companies curbed and curtailed their OPEX and CAPEX plans in light of ongoing uncertainty about end demand and the economic environment. We have started already to see that inflect, and production has already increased, partly reflecting restocking activity and rising capacity utilization, but also the positive impact of capital expenditure plans as companies once again start to invest in their business. Now, industrials had performed reasonably well through calendar year 2020, despite a significant earnings hit. That was very much supported by a re-rating of stocks and an expectation of recovery, but also structural demand for capital expenditure in areas that were largely beneficiaries of the COVID crisis, as the COVID crisis really reinforced long-term ongoing structural themes. So in areas such as supply chain management, factory automation, and semiconductor equipment manufacturing, you saw a robust period of demand and investment in those areas. And what changes going forward is really a broadening out of that activity over coming months, again reflecting more confidence of this cyclical upturn that we expect to see. In fact, lead indicators are at multi-year highs, really reflecting that view that there is going to be a significant uplift in activity. And we're forecasting industrial production to rise somewhere in the region of 10 to 15% over the next 12 months. We were already positioning for that in the third quarter of last year and increasing our industrials exposure. And we continue to do that and have gone further, buying names, for example, that should benefit from ongoing investment. Stocks such as Fortive in the US, which is a manufacturer of precision measuring instrumentation, and Vertiv, again, a US company that is positively exposed to critical infrastructure in data centers, for example. Those are two companies that are going to see significant operating leverage as confidence continues to rise. We're also adding to our exposure in the resources sector and have moved our energy weights up to neutral, really reflecting a view that we will see continuing upside to commodity prices, and that will feed through to the near-term earnings outlook for oil and gas companies particularly. So the outlook for industrial production looks strong and will contribute to that growth. The other side of that equation is clearly personal consumption. And again, whilst the market very much expects to see a recovery in personal consumption, what we think the market has missed is the significant wealth effect that has resulted from favourable monetary policy, which has fueled a boom in house prices, a boom in stock markets, and really resulted in an ability for particularly those individuals who are high income earners to pay down debt and increase their savings ratio. Just to put that into context, we believe that savings in the US have increased over the last 12 months by something in the order of $8 trillion. And just to put that into some context, you would expect in a normal year to see total discretionary spending somewhere in the region of $20 trillion over the course of a year. So 8 trillion increase in savings is a very significant improvement in wealth that will at some time be deployed in discretionary items. And we have been positioned well for that, owning a number of companies that are exposed to the housing market, again in the US, companies like Home Depot and Lowe's, which have benefited from rising expenditure on home improvements and smaller construction projects. We continue to believe that discretionary spending will be allocated in that area. But again, as consumer confidence starts to improve, and we start to see easing of some of these lockdown measures, we'll also see that deployed in terms of some of these luxury goods and discretionary items, and we're positioning for that with, for example, the purchase of US company Tapestry, which owns the affordable luxury bag brands Coach and Kate Stein, for example. So again, positioning for that upturn in spending on luxury goods, fashion items, as people start to extricate themselves from lockdown and start living lives as we would all hope at some point in the future. The third area of focus is really just understanding the impact lockdown has had on investment activity and economic activity. And there is strong empirical evidence to suggest that mobility, social mobility, is a significant driver of economic growth. If you look at Google's mobility data, it will show you those markets that have been significantly impacted by lockdown measures. And lockdown has been much more stringent in some parts of the world, and an easing of lockdown will release pent-up demand, which I think is again under-anticipated by most financial analysts. Lockdown has been very tightly controlled in parts of Western Europe and also the UK. And actually, as those lockdown measures start to ease, we expect to see a release of demand as people are once again allowed to travel and to shop in the high street. And again, we're positioning for that with exposure to hotels and leisure in stocks like Whitbread, the UK manager of hotels in both the UK and Germany, but also TripAdvisor, the online travel bookings aggregator, which again is highly leveraged to an improving dynamic in that particular area. So three areas: industrials, consumption, and easing of lockdown, that I think will shape the transactions within our portfolios over coming months. Before I close, I just wanted to make reference to some of these structural themes that have, as I said, an increasing area of focus over the last 12 months, and I'm sure you're very aware of that. Investing thematically has always something that we have thought about implicitly in a way that we have constructed portfolios, looking for those long-term structural drivers of growth. But today, those investment themes are being incorporated within client portfolios explicitly through specific funds orientated towards some of these long-term structural themes. We believe that structural themes provide an important source of potential return, not because the market misunderstands the themes, but because they fail to model the impact of those themes on long-term revenues and earnings. So it's an inefficiency in the market, really, that we are looking to exploit through an allocation to structural investment themes. Areas of growth has been in the area of sustainability, and particularly environmental themes, and those which are more aligned to climate change. That's also been supporting significant commitment in terms of the spending and stimulus packages that have been put together around the world as central banks and governments have sought to align economic recovery with some of their climate change ambitions. That has caused a significant weight of money into many of these renewable stocks. And whilst we are very confident about the 5 to 10 year outlook for these names, in some areas, some nations look extremely stretched. And I think it is important to be somewhat cautious about those valuations. But structural themes are important, and you should think how a global approach can help you manage and exploit some of those growth drivers in a number of areas, not only climate change, but across disruptive technology, healthcare innovation, and changing lifestyles. So to conclude, I believe that global equity investing has a valuable place within client portfolios alongside a domestic equity allocation. It also provides the flexibility to really adapt quickly to developments as we start to emerge from the COVID virus. But it is also a very powerful tool in terms of exploiting some of these structural long-term themes that are an important component now of client portfolios. With that, I will pause and thank you very much for your attention. I hope you enjoy the rest of the conference, and at some point in the not too distant future, I hope we have time. Thank you.
Thank you so much, Gavin. That was very insightful. And in fact, the number that you mentioned about the increase in savings, like $8 trillion, that's really stuck with me. Well, it's actually true of so many of us personally that savings have gone up. Thank you again, Gavin, for an insightful keynote. We will now look at the results of the poll questions that we opened up. Can we have the results up, please? 72% of our viewers would prioritize minimizing risks, and rightly so. However, I hope that the keynote session has helped you understand that global investing can actually help you address both by maximizing your risk adjusted returns. This is a term you will hear again and again in this conference. Now, coming up next, we look at the various regions of the world that you can invest in. 2021 is a fairly critical year for the world markets, not only because we are emerging from the pandemic, also because we are turning into a new economic cycle more than 10 years after the 2008 global financial crisis. I present to you, ladies and gentlemen, Colin Lowe, Senior Research Analyst from iFAST Financial Singapore, who will present our global outlook. Time permitting, Colin will try and take a few audience questions as well. So please put in questions using the Q&A button that you would like Colin to answer. Over to you, Colin.
Yeah, sure. So just give me a second to share my screen.
Hi, all. Please bear with us. These are the times we're living in. Please bear with Colin while he puts up his presentation slides. He will be back in just a minute.
apologies everybody. So right now I think I'll properly begin with the outlook. So I think there is some technical difficulties right now. So I am Colin, the senior research analyst from the macro research team. So at IFAS Singapore, so it's my pleasure today to talk about the global equity outlook for 2021. So next slide, please. So let's start off right now with painting the macro view. So it is our belief that right now we are in the early phase of the business cycle. So what that means is that we have indeed passed through the trough and are stepping into a global cycle recovery. I think like what Gavin, the presenter earlier, mentioned. So I think perhaps the biggest evidence for this is that this if you look at the global manufacturing PMI, which itself is a cyclical leading indicator. So you can take a closer look at that. So as seen from the table on the left-hand side, you'll find that, hey, global manufacturing cycle or manufacturing PMI across both EMs as well as DMs have rebounded since August and accelerated in the fourth quarter. So while prints in January was rather soft, as can be seen from the boxed area, we find that the expansion is still largely positive, and there is evidence that a global cyclical recovery is in play. So with regards to other economic indicators, if you were to look at even the services or the composite PMIs, as well as some of this industrial production growth, you'll find that the evidence point to the same thing, where they are pointing to increasing momentum in the global cyclical recovery. So if you can take a look at the right-hand side, and according to history, you'll find that, hey, a cyclical recovery tends to be very robust after a recession or a crisis. So this time around, we expect no difference. And that brings me to my next point. So next slide, please. So overall, for this year, we hold a constructive view on global growth. And we believe a major theme this year will be a vaccine-led cyclical recovery. So our positivity extends to the growth numbers as well, as we are also expecting a above consensus global GDP growth for 2021 at 5.6% year-on-year this year. And if you look at the growth forecast across the different regions, we believe strongly that Asia ex-Japan is likely the growth driver for the year. And the growth outperformance for Asia and Japan will continue to widen as compared to some other regions, such as your Eurozone or your US or even Japan, where I think 2020 they were hit rather badly. So this outperformance in growth itself will tend to drive the equity portfolio flows into those markets with a stronger growth. So next slide. So right here is one of the raging topic these days. So inflation itself is a big topic. So as shown from the chart right here, you can see that while the inflation magnitude differs amongst the major economies, the trend is similar. Inflation itself is picking up, and it's not just a localized event for a particular country, a particular market. It is rather a global one. So with that said, we expect the US core PCE is the matrix that the Federal Reserve look closely at. We expect that to come in around 2 to 2.4%, and that number itself, well, it might not mean anything to some of you guys, but in general, to us, that means that we will likely see a low risk of a runaway inflation. And with that said, this means that the big reflation narrative right now that is happening should dominate markets this year largely, and equity markets may fare decently under this reflationary undercurrent. So next slide. So broadly in this year, we're also expecting that there will be a robust corporate profit recovery this year. So as shown from this chart right here, cyclical markets will lead this recovery. So most of the cyclical markets itself are generally emerging markets, and with the exception of Europe. So of course, if you look at that, a large driver for this EPS recovery will be coming from base effect. But the other main reason is that most of these markets itself have a much higher weightage of cyclical sectors, such as your financials, your materials, and energy, as well as the industrial sectors, which we believe they should see disproportionately higher EPS rebound for the year. And that itself should drive EPS growth significantly. And if you look at global valuations that that have shot up really rapidly over the past couple of quarters, you'll find that, hey, indeed, the recovery for markets since last year's March was largely driven by valuation expansion. So this re-emphasized the importance of earnings, where we believe that strong earnings must come in this year to justify such level of valuations. And with that said, strong earnings can be found in some of these emerging markets as well. So next slide. All right, so broadly, if we were to take a higher level look at the risk backdrop, we'll find that, in fact, several key risks as well as headwinds have subsided. So, for example, a major worry initially was COVID uncertainty as well as US-China tension. So we find that both have actually receded rather significantly lately. And if you look at some of these major event risks that happened over the past few years, I think the major one that stood out was US election. So in that, the fear of a US election and some of the uncertainty that follows are gradually clearing. And for this year itself, we see no major risk, event risks that will rock the asset classes. So that leaves us to one of the last key risks, which is inflation risk. So that itself was initially more like a deflation risk, which soon morphed into some of this inflation concern. But like as I alluded earlier, we believe that it is not a major concern for markets right now, and certainly not a major concern for equity markets. So next slide. So right, if we were to put all things together, you'll find that the macro backdrop itself favors risk assets, and in particular equity markets. So like what I said just now, and like what I went through, we see a couple of factors supporting this thesis. So number one would be robust EPS recovery, and number two would be a supportive policy backdrop. Number three, it is a macro recovery, which is underpinned by your improving growth as well as a reflation undercurrent. And last but certainly not least, will be a milder risk backdrop in this year. So broadly speaking, this setup itself favors equity amongst the other asset classes, and we think it pays to be pro-risk as well as having a pro-cyclical exposure for the year. So next slide. And to really convey and express this view of being pro-risk and pro-cyclical, we believe that two regions within the equity market that stands out to us. So number one is the emerging markets, and number two is the Asia ex-Japan equity markets. So both of them have a favorable outlook, and we do expect strong performance in this year. So next slide. So right now I'll be touching firstly on EM equities before I proceed to Asia ex-Japan equities. So over the next couple of slides, I will go through some of these drivers and why we favor EM equities. So firstly, we see a big cyclical boost to EM economic as well as EM profit recovery. So if you look across the board, you'll find that across history, cyclical recovery in the EM markets tends to be very strong, and especially emerging from the recession or even a crisis, EM GDP growth itself can be above its long-term trend. So I think this is no difference this year as well, and we believe that this GDP growth itself should come in above consensus, and that itself should be a major driver for equity markets. And if you look at the corporate earnings itself, that's the same thing. After a crisis or after a recession, the rebound tends to be very strong, and again, it tends to be within the range of 30 to 60%, and a large part of it is actually due to the EM's huge single exposure, which comes in at around 60 to 70% of the entire index. So with that, we do see above a consensus EPS growth for this year as well as the next year, and that should also anchor your EM equity markets moving ahead. So next slide. And overall, within the EM equities, we see that they are highly exposed to various key tailwinds. So number one will be a weak US dollar. So we do believe that US dollar is now in its the onset of its bear market. So that itself should provide strong support for the years ahead. So first and foremost, for the US dollar itself, we think that weak US dollar is very positive for emerging markets. So if you can take a look at the chart on the left-hand side, we'll find a very strong negative correlation whereby whenever the USD weakens, EM equity strengthens. So the weakness for US dollar itself will feed into commodity prices, and we believe that alongside this this ongoing supply-demand mismatch for most of these commodity complexes, we'll find a very strong thesis that commodity prices should go a lot more high in the years ahead. But so what this means is it is something very, very beneficial for emerging markets. So if you can take a look at the chart on the right, so almost similar to the chart on the left, where we find that, hey, whenever the commodity price rises, EM equity actually benefits significantly. And I think, as mentioned by Gavin earlier, so rising commodity prices will, in the near term, feed back into the corporate earnings, where we find that if you were to look at the relationship between commodity price index versus the EM's corporate earnings, or EM EPS, so you'll find there is quite a strong leading relationship, a leading positive correlation within that. So next slide. Right. So let me move on to Asia Japan equities. So I do know that a big part of Asia Japan equity falls under the EM universe as well, and therefore they are also facing some of the similar tailwinds that the EM equities are, like I mentioned earlier, EM equities faces. So, but there is quite a good distinction between with Asia Japan equities, is that they're actually backed by stronger macro fundamentals as opposed to some of the other EM areas such as your Latin America or even your EMEA region. So broadly, on a top-down level, we find the very strong macro data in Asia right now. So over the past quarter itself, most of the economic indicators are in fact beating consensus expectations since early October 2020. So that is denoted by the chart on the left-hand side, where the City Economic Surprise Index have actually crossed above zero, and crossing above zero is an indication that more and more economic indicators are actually beating their consensus estimation, and that is a good sign for Asian equities themselves. And if you look at more of a longer-term picture, you'll find that, in fact, we believe that the economic outperformance of for Asia is likely to continue ahead. So early on, you see the GDP chart, GDP forecast for the different regions. So right now, this is a line chart where it clearly shows that, hey, the Asia ex-Japan's growth itself, which is denoted by the purple line, for the next couple of years we continue to believe that it will widen ahead. And with that said, this economic outperformance itself should continue to widen, therefore driving making the equity markets for Asia more attractive relative to some of the other regions on a longer term basis. So next slide. Okay, so right here you see the chart for the earning estimates on a 12-month earning estimates for Asian and Japan equities. So you'll see a very positive message for this chart, where we believe that Asia and Japan equities, on top of leading the global economic growth recovery, it will also lead the global global EPS recovery as well. So the chart right here shows the earning estimates are in fact above pre-COVID level. And if you look at somewhere along July, there is a very, very strong upwards revision since July 2020. And that positive revision has been carried into 2021, and we see a recent acceleration of this, especially after November period, where it is after the US general election, as well as the news from the Pfizer's vaccine side. So that itself is a very telling sign that, hey, fundamentals for Asia and Japan is actually pretty strong, both from the macro perspective as well as a corporate perspective. So next slide. Right, so here within the global equity market itself, our top picks for this global equities are in fact China, Hong Kong, South Korea, Indonesia, and Brazil. But you may notice that over the past few days or last week, in fact, Hong Kong and Brazilian equity took a hit lately. But after reevaluating our thesis and why they were hit that bad over the past couple of days, we believe that the fundamental aspect of these two markets are still intact and in fact still relatively attractive. So on top of that, if you look at things from a contrarian perspective, you'll find that some of this recent sell-off itself in fact helps to clear away the froth in these markets. So that itself can be very beneficial for investors when you're looking at this couple of markets. So with that said, we do believe that opportunities for 2021 lie within the emerging market, as well as some of these Asia ex-Japan equities. And broadly speaking, EM Asia, however, still offers a better risk-reward profile at the current moment. So, but investors themselves shouldn't disregard the other regions because they can and they should diversify into EMX Asia, especially when the global recovery as well as the vaccination program gathers pace. I think when that happens, the risk reward profile will be much better for these markets, especially from the risk side. So because of that, I think we also broadly see attractive opportunities within the EMX Asia region, such as your Brazil as well as your Russia, which are very good, I think, cyclical plays as well as commodity plays. So I think those who some of these markets itself stands out, particularly in the early business cycle. I think the macro setup for is quite perfect for a couple of these markets. But with that said, I think these are our top equity markets, and I want to reiterate the idea that I think to best play this pro-cyclical as well as pro risk exposure for this year, I think the best way to do it is through Asia ex Japan as well as some of these EM markets. But I think when the economic growth picks up, the investors themselves can diversify into EMX Asia. So I think that is one of our key messages. And with that, I come to the end of my presentation right here. So I think with that, I should hand the time back to Deepali. So Deepali, please.
Hi, Colin. Thank you so much. Colin, we do have time for one quick question from the audience. The question is the market expensive considering the EPS of 2022? Can you give us a quick answer to this, please?
Hi. Broadly, if you look at markets in general, as in the global markets as a whole, they are looking at slightly frothy. So I think that is something that we cannot escape from. That markets are indeed looking slightly expensive, but I think we have to segregate markets through the cyclical markets as well as the less cyclical markets. I think if you look at cyclical markets through the lens of more of a multi-year EPS recovery, then itself it look more attractive when it comes to valuation, because valuation for this year might be expensive, but we are in fact, like I mentioned earlier in my slides, in fact expecting strong EPS recovery for the next 2 to 3 years. So early on, also like I mentioned, in the early phase of the business cycle, the EPS growth can be very strong and can tend to surprise to the upside. So once all that fits back into your PE, if you're using that as a convention denominator for valuation, you'll find that if valuations from a longer term perspective is in fact more attractive for some of these markets. And therefore, I think if you were to look at things from this perspective and taking a slightly longer time frame, you'll find a better answer to that question. Yeah.
Thank you, Colin. I think that's a fair answer. We need to take a longer term view of things right now. Thank you so much for your insightful session, Colin.
Thank you.
Yeah. Bye. We now come to the next question that we're asking in this conference. Our previous sessions have spoken convincingly, I'd say, about how the world is going to look at an upcycle in the markets. The question then is, how do we gain from it, and where do we invest? The answer to this lies in the iFAST Financial Recommended Global Mutual Funds report. And to present our selection of 8 mutual funds, global mutual funds from India, is our very own Krishna Karwa, Senior Research Analyst from iFAST Financial India. Over to you, Krishna.
All right. Thank you very much, Deepali. Good evening, one and all. I am Krishna Karwa, a Senior Research Analyst at iFAST Financial India Private Limited. It gives me immense pride and happiness to present to all of you India's first ever recommended global funds. So without further ado, let me start sharing my screen. One moment, please. Okay, so when one refers to global funds, the first word that comes to everyone's mind is diversification. And what better way to explain this than looking at 2020 as an example? In March, when the markets declined, the quantum of the decline was not uniform. Similarly, when they made a bounce back thereafter, The quantum of the rise was not the same. This clearly shows you that if you invest in more regions across the globe, you not only limit your downside risk, but also derive a good upside when things turn for the better. So in terms of the fund selection process that we have followed, most points out here are pretty self-explanatory. I would like to talk about the one highlighted in red, which represents the regional star ratings. Remember, India has offices, or iFast has offices in 5 Asian markets, namely India, Malaysia, Singapore, China, and Hong Kong. There's a team of 26 analysts who closely track 15 geographies. In the Indian context, it is therefore important that we leverage their expertise and knowledge to help our investors make money. And the methodology that is followed in terms of the star ratings is fairly simple. We take into account market and economic variables to determine a reasonable upside over a 2 to 3 year period. And these are the star ratings at this point in time, 5 being the most attractive and 1 being the least attractive. We are relatively more optimistic about Greater China, Asia Pacific as a whole, and emerging markets as a space. In terms of risk ratings, we follow a scale from 1 to 10. 1 to 3 cover the debt mutual fund space, 4 and 5 pertain to hybrid funds, whereas rank 6 to 10 pertain to equities. And as you can see here, popular to what most people feel, global investing is safer than investing in India. Exposure, they can confine themselves to the first couple of names. For the US, we have chosen a passive fund and an active fund. A passive fund that is benchmarked to a headline index can actually help limit volatility during drawdowns, whereas it's the active fund that will outperform the passive fund at a time when the broader markets rally. And that is what we are witnessing at this point in time. In the Asia Pacific space, we have chosen to opt for the 3 big regions, that is China, Japan, and India. In the European space, not too many options available in India, so we've chosen the best of the lot. These are a couple of important terms that all of us need to know. One is the feeder fund and one is the mother fund. So the feeder fund is an Indian AMC whose role is to provide Indian investors access to global equities. This fund in turn will invest in the mother fund, and the mother fund, which happens to be the foreign AMC, then decides on the stock and sectoral composition. So on that note, let's move on to fund number 1, and we'll tell you why we shortlisted this. That's because this mother fund, that is Schroders, is a big brand with presence in 37 countries across the globe. It's also been in existence for the last 15 years and primarily exposes itself to developed markets. Even out there, there is a fair bit of diversification. Of late, however, the fund manager has been eyeing more opportunities in the Asia Pacific space. This pie chart clearly shows you how US is a dominant occupies a dominant share of the overall portfolio, but you can see this number coming down and the Asia Pacific exposure going up. And in terms of return profiles, a pretty good set of numbers again. And if you take INR's depreciation against the USD into account, one can derive an incremental set of returns. All right, so fund number 2 pertains to the emerging markets, and the reason why we like this fund is because there is a high exposure to Eastern Asia and more particularly to China. It's also one of those funds that has been in existence for a fairly long period of time, that is 20 odd years, and it covers all major emerging markets in varying degrees. It's also one fund which has outperformed its benchmark over the long term. The feeder fund, on the other hand, is among the best performers in the emerging market space. And this chart shows you the exposure by country. There is a fair bit of exposure to emerging markets like Russia, India, and Brazil as well, among others. And this is the chart that highlights the outperformance of the mother fund. And the return profile, as seen by the difference in columns 3 and 2, represents the impact of INR's depreciation versus the US dollar. We move to fund number 3, which pertains to the S&P 500 index. It's a passive fund, so the first 3 points clearly articulate the benefits of passive investing. It's also the best gauge of the US markets, and more importantly, it is diversified versus the Nasdaq 100 index. The text in red highlights the differences between the two indices, and as you can see, an uptick in cyclical sectors clearly seems to augur well for the S&P 500 index. And here's a look at the return profile. The S&P 500 has outperformed the Nifty 50 over a 10-year period. And if you take into account, once again, the currency advantage, the returns of the S&P 500 will be even better. We move to fund number 4, which pertains to the US markets again. And this is an actively managed fund by Franklin. So the mother fund has been in existence for over 20 years, whereas the management team has been the same for over 15 years. It is market cap agnostic in nature, so you will have a fair bit of exposure to the small and mid cap space as well. However, there is also a good balance of cyclical and secular growth themes, which not only provide a stability to the overall portfolio, but also leave enough room to derive incremental returns. The feeder fund in India has been the best performer in this space. And the text in red once again highlights the sectoral exposure in favor of cyclicals to the tune of 40%. So there is a good upside opportunity out here. And these are the historical numbers. The column 3 versus column 2, once again highlighting the advantage due to currency movements. Fund number 5, which is a recent launch from Axis, pertains to Greater China. And the reason why we like this fund is because of the Schroeder brand that I spoke about earlier. The fund has been in existence for over 19 years, and the fund manager has been linked to the AMC for over 24 years. In fact, she heads the Asia Pacific division at Schroders for equities. More importantly, the mother fund has outperformed its benchmark consistently over the long haul. And this outperformance is even more stark in the last 1 year. And as I highlighted early on, China has been one of the best performing markets in the last 12 months, and that's clearly seen in the bar on the left. Fund number 6, which pertains to Japan, is an offering by Nippon. The reason why we like this fund is because it predominantly is invested in the secular growth space. However, the fund manager is open to taking exposures even in the disruptive and innovation space, and that's something Japan, as we all know, is clearly well known for. Stocks are selected using a meticulous combination of top-line growth, sectoral leadership, and resilience to global and domestic economic challenges. However, it is the exposure to global brands like Toyota, Mitsubishi, and Uniqlo, among others, that should draw one's attention to this fund as well. Over the long haul, once again, the rupee has depreciated against the yen. And if this trend continues, one can derive an incremental return to that extent. Excuse me. Yes. So let me move on to fund number 7, which pertains to the Nifty Next 50 index. This is a passive product, so the benefits of that investing clearly are highlighted here. The most important thing, however, is that it is more diversified versus the Nifty 50 index and has exposure to new age sectors such as insurance, consumer discretionary, and pharma. And this is in stark contrast to sectors like banking and IT, which are relatively more well discovered in the Nifty 50 index. And here's a look at the historical performance of this fund. All right, so let me then come to the final fund, which pertains to Europe. The reason why we like this fund is because this fund will invest primarily in the developed side of Europe, where the monetary and fiscal stimulus capabilities are relatively better to combat the COVID-19 crisis. The stock selection is a combination of value, growth, and momentum picks. It is also market cap agnostic in nature, so there is going to be a good degree of exposure to the small and mid caps. However, it is the consistent outperformance during the last 10 years that is worth taking note of. The feeder fund has been the best performing in this space in India as well. So this chart clearly highlights the difference between the fund and the mother fund and its benchmark. And the subsequent chart that you see here shows you the region-wise exposure. Clearly, the scales are tilted in favor of United Kingdom and Germany, two of the largest economies in Europe. And you have a decent bit of exposure to some of the other developed markets out there as well. The historical numbers may not seem so impressive, but remember, Europe could be poised for a strong re-rating on the back of an uptick in value stocks and a favorable outlook for emerging markets, which comprise a major chunk of European exports. A few questions that all of you might have in mind is, number one, can you download a copy of the presentation and the report? Definitely yes. Please visit the iFast online booth and download your copy at the earliest. More importantly, a lot of investors have two common questions in mind all the time. Number one, where do I invest? And number two, how do I invest? I touched upon the first question already by virtue of this presentation. However, if you would like to know more about asset allocation, don't forget to log in at 5:45 p.m. tomorrow for a session on India's first global model portfolios. My colleague Rachna Makhija will shed some light on that. For any queries that you might have, please do post them in the chat box. Alternatively, you can drop us an email at research.in@ifastfinancial.com, or you can get in touch with a business development representative who will route your queries to us. Well, that brings me to the end of my presentation. Thank you one and all for your patient listening, and have a pleasant evening ahead. Over to you, Dipali.
Thank you so much, Krishna. Ladies and gentlemen, as Krishna mentioned, if you want to download the Global Recommended Funds Report, or in fact, if you want to relook at any of our speaker presentations, please do visit the iFast Financial booth. All of this material has been made available there. We have now also opened another poll for all of our audience members who are financial intermediaries. Now, be it advisors, distributors, or financial planners. This poll is brought to us by our knowledge partners, ARIA, the Association of Registered Investment Advisors. Please do take this poll and we will compile the responses shortly. At this point, I'd like to announce a short 10-minute break, but please don't go anywhere. We have two announcements coming up that you don't want to miss. See you back in 10.
लाइफ चाहे जिस मोड़ पे लाके खड़ा कर दे, सपनों के सफर की शुरुआत वहीं से हो सकती है। जैसे डेस्क जॉब की सैलरी से रेगुलरली इन्वेस्ट करके म्यूजिशियन बनने की शुरुआत, नौकरी की कमाई से रेगुलरली इन्वेस्ट करके अपना बॉस खुद बनने की शुरुआत, रिटायरमेंट के बाद के शौक पूरे करने के लिए आज से रेगुलरली इन्वेस्ट करने की शुरुआत। छोटी छोटी रकम रेगुलरली इन्वेस्ट करके बेटी के बड़े ख्वाब पूरे करने की शुरुआत। अपने सफर की शुरुआत करने के लिए अगर आप हैं ओपन, तो SIP के साथ म्यूचुअल फंड्स में इन्वेस्ट करने की राह है ओपन। तो करो शुरुआत SIP से। An investor education and awareness initiative by Axis Mutual Fund. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Equity investing has got fancy of everyone around us, and why shouldn't it? Equities have helped investors create tremendous wealth over the long term, but it's not easy for an investor, as there are thousands of stocks to choose from and hundreds of mutual fund schemes to select from. That's where investors can consider passive investing approach, which simply tracks and invests in the portfolio of a market-wide index. Unlike active investing, wherein the fund manager takes investment decisions to buy or sell every stock of the portfolio, under passive investing, fund manager has to replicate the index portfolio and manage stock level asset allocation accordingly. One of the most common forms of passive investing is index fund. An index fund represents a basket of stocks that mirror the securities of an index, such as the Nifty or the Sensex, to match the performance of an index. So, an index fund tracking the Nifty 50 index would invest in the same 50 companies and in the same proportion as the Nifty 50 index. Index investing offers ease, as you just have to select the index and your investment will be diversified across numerous stocks and various indices or various sectors at the click of a button. You do not have to even worry about rebalancing the portfolio based on any changes in the underlying index. Economy, as they usually have significantly lower expense ratio as compared to active funds, and even costs less than buying those stocks individually, because it doesn't require active fund management to select stocks or formulate investment strategies. That's why there is a significant increase in the corpus in index funds over the years, from 20 billion in 2009 to 800 billion in 2018. Effectiveness, as the historical performance of Sensex for various periods is an evidence that investing in an index fund has resulted in significant wealth creation over the long term. No wonder why many successful investors recommend index funds to new as well as existing investors because of its low cost, simplicity and effectiveness. What's more, index or passive funds are one of the most sought after investment products. It has been growing in popularity world over, and India is no exception. So if you're not certain about which stocks to go for, wish to invest for the long term, and want to stay away from constant monitoring and reshuffling your portfolio, invest in index funds of your choice today and enjoy low-cost investing. Passive funds also include ETFs. We will learn more about ETFs in our subsequent videos. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello, friends. My name is Pratik Oswal, and I'm currently heading passive funds at Motilal Oswal AMC. We are very excited to launch our new NFO. So the new fund that we're launching is the S&P 500 Index Fund. So the S&P 500 is a very, very historic fund. It was the first ever passive fund ever launched in the world back in the 1970s. And today, almost 50 years later, it's today the largest and the most popular index in the world. So it's just to give you an example of scale. 3 out of the 4 largest mutual funds in the world are all S&P 500 index funds. And if anyone wants to know how the US economy is doing, they talk about the S&P 500 fund. So it's a very important fund, and this is coming for the first time to India, brought by the MOAMC. So why is this relevant for Indian investors here? So with this fund, investors are getting access to some of the largest companies and some of the best brands in the world. So if I show you today the list of brands in the S&P 500, and if I show you a list of the brands in the Nifty 500, which is the Indian index, you would probably identify more with the S&P 500. So it's a great way of diversifying your portfolio. Number one. The other thing that I think is great about this fund is that it gives you a dollar as an asset class on your portfolio. So if you think about it, the dollar has used to be 40 rupees and now it's close to 80 rupees in the last 10 years. So I think, and today a lot of our expenses are happening in dollar terms. So for example, if you had to send your kids for education institutions abroad, you would ideally want to have those savings, held in a dollar-based asset, because as so the cost of education going abroad has gone up 2 to 3 times over the last 10 years. Apart from education, we're also buying more products that are more international. We're doing more foreign trips. So I think every investor should have a minimum of 10 to 15% of their portfolio in international funds. And the S&P 500 is very simple. It's a simple index fund. So most investors will be saving a lot of fees. They don't have to worry about, picking a right fund manager. And it's also one of the most reputed indexes out there in the world. So with that, thank you so much and look forward to having your support on our NFO. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents.
Welcome back, everyone. Can we please have poll results on screen? Okay. A majority of our viewers have responded that fee structure and willingness of investors to pay is the biggest impediment to starting a pure advisory practice. This is definitely an interesting insight. Please do join Arya for the breakout session tomorrow on day 2, 6:30 to 7:30 for more discussions on insights like these. Now, moving on, listening to the previous speakers, I'm wondering if you guys had the same thought that I did. What if I want to invest in these markets directly? The US market, especially, offers a lot of attractive options and is already seeing significant investment from savvy Indian investors. Well, with the internet and digital technology, it is possible to invest directly into the US stock market today. And I'm very proud to announce that very soon, iFast Financial India is also bringing this capability. I show you now a small video with a sneak peek of our upcoming launch of US equities and ETF investments. Exciting, isn't it? But here's something we believe in at iFast Financial. Technology alone cannot be a complete solution for investors, which is why, along with being known as one of Asia's leading fintech platforms, we're also known for our cutting edge and independent research recommendations. We had the same thought when we were planning this investment conference. What new and exciting idea can we bring for our investors? Very, very excited to announce, ladies and gentlemen, that we have for you a recorded video by Catherine Woods appearing for the very first time on an Indian conference. Now, Catherine Wood is the CEO and founder of ARC Investment Managers. She is known globally for her extremely innovative investment ideas. I bring to you her talk on disruptive innovation investing. Catherine Wood.
Greetings. My name is Kathy Wood. I am CEO and CIO of ARC Invest. We have been saying for a very long time that 5 innovation platforms that involve 14 technologies are ready for prime time. The coronavirus crisis has turbocharged all of them. They are in prime time. That is why they're taking off at a much faster rate than even we expected. And we've been trying to communicate the opportunity, and many people have received that well, which is great. But then as we're talking to investors, we have been a bit frustrated that we haven't been able to communicate to those who really feel like the broad-based benchmarks are where they are the safest place for them to gain exposure to the stock market broadly. And so we put out, in order to illustrate that that is not true, that the broad-based benchmarks are not a good place these days because of all of this innovation, we put out a report called Bad Ideas. It's on our site. And we talked about all of the fixed assets that are effectively becoming stranded assets, whether we're talking retail or banking or energy or anything auto related, even auto insurance. We think that a lot of sectors are in harm's way, and those sectors make up more than a third of the S&P 500. Which is the benchmark that many people use as their gauge. So 35% is a big risk and will lead to, we believe, subpar returns. So I'd ask any of you who are wondering about the fixed assets that are going to be stranded and why they're going to be stranded and why book values are going to be written down. Exxon last Friday wrote down, I think it was somewhere between 20 and $30 billion, which is about, just for perspective, about 20% of its equity market cap, which is crazy. But it's true. And that's because innovation is just blasting through the traditional world order. Now, more on innovation during this post-COVID crisis environment. Some interesting convergences are taking place. We know we've gone remote to work. We know we're enjoying digital entertainment. We know we are going to the doctors through virtual visits. But something else is happening. There's a convergence among all of these digital services. We're seeing a convergence between entertainment and gaming. So social gaming, streaming gaming. We're seeing social commerce, so combination of online retail and a social experience like group buying or influencers helping us figure out what to buy and why. And social media is developing new dimensions with virtual reality and augmented reality. So we believe that we are moving into a digital third place, the metaverse. So there's always a question of valuation when we're talking about innovation. And it is true, the PE ratios of innovative companies are very high today, but there's an important reason why. Many of them are investing aggressively now because these exponential growth opportunities are in very early days, and many of them are winner take most. In other words, the companies with the highest quality data and the most data and the best artificial intelligence expertise are going to run away with some of these markets, be the dominant players. Now, many people compare today to the tech and telecom bubble. It couldn't be more different. In the tech and telecom bubble, the seeds for all of the innovation taking place now were planted. But they were planted and they were going to take 15 to 20 years to gestate. So here we are 15 to 20 years later, and these technologies are ready for prime time. So we are not going to have to value stocks using number of potential eyeballs, which is what investors did and speculators did in the tech and telecom bubble. Today, we are looking 5 years out and we're saying, where is this exponential growth going to take this network, this platform, this technology? And if the growth is exponential, we are willing to pay a lot today for companies to sacrifice short-term profits in order to capitalize on some of the biggest investment opportunities of our lifetimes. So we at ARK and at Nikko Asset Management, our partner, we are ready and waiting to help you stay on the right side of innovation, the right side of change, and to a very exciting new world order. Thank you very much.
Wow, that was some thought-provoking stuff. Ladies and gentlemen, Catherine's message was brought to us courtesy of Nikko Asset Management, Japan. Now, Catherine's take on broad-based investing is perhaps contrarian to what a lot of us practice as retail investors. But then again, that's probably what makes her such an interesting thought leader in this domain. Now, speaking of thought leaders, our next speaker is Prateek Oswal, Head of Passive Investing from Motilal Oswal Asset Management. Prateek is a true blue fintech entrepreneur with experience working in Silicon Valley, as well as the more traditional domains of investment banking, hedge funds, and private equity. Prateek handles the S&P 500 Index Fund, which is part of our recommendation report, and is here to talk to us about their outlook and strategy for the US market in 2021. Welcome, Prateek.
Hi, Dipali. Nice. And thank you, iFast, for having me out here. Look forward to having a great conversation with all of you. I think for today's session, I'm going to be talking about two things. One is, what's really happening in the US. A lot of people are asking questions about, where markets are right now, and does it make sense about where the markets are, and what is the sort of roadmap in the future. And second is more of a, I would say, theoretical exercise about how you should go about investing abroad. I have been talking about international investing for almost 2 years now. and it's good to know that it has picked up in a very big way, and hopefully we can at least speed in the process going forward as well, because from my experience, and I have managed to I would say manage money for investors in the US for many years, and what I've seen is that India is grossly underpenetrated. We are mostly investing in the domestic market, which is not bad, obviously, but I think it's good to have international allocation for diversification. So let me just share my presentation, and then we can open it up, and then maybe I'll spend 10 minutes on my presentation, and then we can. Sorry. I hope you can see my presentation. So essentially, so I'm going to divide my presentation into two parts, as I said. First is about US markets. I'll just quickly run through the US markets, and then I'll talk about international diversification from a very different lens. Obviously, I have been talking about international diversification from a US perspective, but today I'm also going to talk about how you can look at it from an emerging markets or a developed markets perspective, which is outside the US. So let's talk about the US economy. So I would say really interesting in terms of how things have panned out in the US. I do think that unemployment was as high as 15% back in April when the entire crisis started, but it's back down to around 6.5%. So it's been an absolute crazy reversal when it comes to the unemployment rate in the US. This is obviously the most important statistic for the government, and I think it's good to know that things are sort of moving back in the right direction. Obviously, the vaccine came into play sometime end of last year, and we do feel that by the end of this year, you will have a major part of the population being vaccinated. Let's talk about why the markets are where they are. I think people obviously talking about I think multiple I would say money supply and printing money and all of that. I do agree that I think it's important to keep in perspective that even though this may not be a good thing, this is literally what really saved the economy from a really bigger crisis that could have happened if this hadn't happened. A lot of companies out there could have gone ahead and filed bankruptcy has it not been for the money printing and making sure that a lot of companies are willing to sort of refinance their liabilities. So I do feel that yes, it has been a lot of it in the last 1 to 2 years, but I do feel that at least in the crisis, the reason why we have seen such a crazy, I would say, U-turn or a V-shaped recovery so far is because of the money printing. So it is there. The other side or the negative side of money printing is that no one really knows how this will pan out in the long run. People have had, there are some a lot of I would say people are talking about hyperinflation or talking about really something bad that goes to the dollar. But we have seen that in countries like Japan, where the debt is a lot higher than the US, they haven't really seen any long-term impact. Well, this is obviously as per time to come, but so far I think one thing that has really helped the economy come back to where it was say before the crisis is this particular thing. And because of obviously the money printing that has happened, I think government debt has also increased quite a bit. This has been the highest in the last, I think, highest ever in history. And even the debt to GDP is quite high. So yes, this is not the highest in the world. You have countries in Europe and in countries like Asia, which much higher debt sort of ratios, but nevertheless, I would say not something which a lot of investors should see. So let's talk about GDP recovery. This is a very good chart that talks about how staggering the COVID crisis has been. The drop has been quite significant, but the pullback has been quite significant, as you can see on the extreme right side of this map. This chart talks from the 1940s. So in the last 100 years, this has been the biggest shock that has happened in US GDP. So I think the good thing is that you have this recovery that's happening, which I think is great to see overall. So about recovery again, coming back to recovery, as I said, we are expecting a V-shaped recovery in the US markets. So I think I do feel that hopefully if things move on to the way they are, we'll see earnings obviously has been really good overall, but we do feel that GDP is expected to come back to where it was by the end of this year. So let's talk about, I would say, valuations. Valuations is a big topic today. Everybody is talking about crazy high valuations, especially. So there's valuations and there's concentration. The top 5 or 6 securities value are about 20% of the entire S&P 500 index. So there is concentration happening. but there's also a lot of high valuations. But if you look at equity risk premium, so what that means is that valuations have to be seen from a lens of interest rates. Last time the valuations were high, interest rates were at 5 or 6%. Today interest rates are 0%. So what that means is that your higher valuations, your equity risk premium is pretty much, yes, it's elevated, but not as high as what most people think. But nevertheless, I think going on from here, we are recommending investors to take a slightly more SIP route. They're expecting markets to be volatile. Essentially, we do believe that no one can really know where the markets will head in 3 months or 6 months to 10 months. But the real reason to why you should diversify is obviously diversification itself. So yes, it's expensive, but what we've seen is that if you account for 0% interest rates, then it's pretty much the same level as what we saw, or in fact lower than what we saw in the tech bubble in 2000. So so let's talk about, people are talking about the tech bubble. Let's talk about is there a tech bubble? And obviously I'm sure there'll be questions on this at all. But what we've seen is that in 2000, and this is all the way back about 21 years ago, there was a huge valuation expansion, but earnings was quite limited or close to zero. A lot of the valuation was based on fluff and based on expectations, which is why you had the huge crash. But if you take that into perspective from today's time, you'll see that valuations obviously are slightly on the higher side, but the earnings have been quite explosive. Last 10 years, if you see some of the most money-making machines, that those have been the technology companies, the top 5, top 10, top 20, top 30 companies. So we do believe that even though yes, valuations are on the higher side, we do believe that you have to look at it from an earnings perspective, and the earnings are a lot higher than it used to be. I think 15, 20 years ago. So the market has matured, tech industry has matured, and now it's become a money-making machine. So that was, I would say, very, very small perspective on, where the markets are and what we expect in terms of things going forward. Just want to spend maybe 5 to 7 minutes, talking about, why you should invest in the US equities. And I will start with, today, close to 97% of the world's opportunities in investing lie outside of India. India is only 3% of the world GDP market share. We are missing out on close to 97%. And if you look at the 97%, 55 to 60% of the world GDP is concentrated in the US, around 30% in developed markets, and 12% in emerging markets. And we are a subset of emerging markets. So I think it's extremely important to understand that there's a lot of wealth creation opportunities outside of India. And we are today, I would say, still most investors today are heavily weighted towards India, which is not bad, but I would say that you are taking on a lot of domestic risk, which can be diversified away by looking at investing abroad. And if you look at India and the US, just look at these two countries. India has high GDP growth, but we're looking at a country. It's a very good combination because India is obviously a high growth country, but also US GDP. US is the highest GDP country. So the combination is quite unique, where you have the world's largest country and one of the world's fastest growing countries in the same portfolio, which is why I think, your combined exposure, if you just simply add an S&P 500 fund or any diversified US fund, can increase from 3% to almost 30%. So that's the value of international diversification that you can see. One big reason to why you should diversify is the quality of companies that you can get in these indices. So these are some of the companies, and as you can see, these are not really American companies; these are global companies. I think most investors would have bought or sold or dealt with these companies at some point of time, or a lot of us actually engage with these companies on a daily basis. So you're not really buying US equity; you are buying global companies. And more importantly, I think the biggest reason to why you should diversify is low correlation. What does that mean? Today, if you look at Indian equity, whether you buy a large cap fund or a mid cap fund or a small cap fund, everything moves down together in a bad market. So you must have seen in March of last year, everything was down 20, 30, 40%. So there's not a lot of correlation. There's a lot of correlation, 90% plus when it comes to Indian equity. And when it comes to Indian equity versus US equity, the correlation falls down to 20, 25%. What that means is that it gives you a lot of downside protection. If you add a US fund or an international fund to your Indian portfolio, what it will give you, the returns are pretty much the same. But when Indian markets do badly, US markets do not do badly, and vice versa. So you're essentially getting two asset classes that move in different directions at the same time give you excellent returns. So I think that's a really true reason. And the other reason is that today a lot of people are looking at debt, are looking at real estate, are looking at gold. But the problem is that you're giving up on returns for lesser risk. This is the only asset class today where the returns are pretty much the same. In fact, 10 years returns have been a lot better, but the risk has fallen dramatically. So I think that's the key reason to why people should be looking at the international funds. And just to give an example, this is something I talked about earlier. 40% of the revenue of these companies are coming from their operations outside of the US. So truly, if you're buying these global companies, you're not only buying the US, but you're also buying the global landscape, which is why it's a good form of international diversification, looking at the US. Looking at the risk return, I think the risk return payoff, out here, as you can see, this is a slightly more complicated graph, but basically what it shows is that by adding, so the Nifty 500 is out here, all the way in the bottom right. And by adding an S&P 500 or Nifty 500, you're essentially lowering your risk and you're increasing return. And as you can see, the optimum allocation is around 650-50. But I do think that obviously, as an Indian investor, you should be looking at international stocks as a diversification tool. So we are recommending having a minimum of 20-25% of your portfolio in international securities, and the rest obviously can be invested in India. So I do feel that it's important from a risk and a return perspective, when it comes to international diversification. Lastly, and this is very important, is that when you're looking at diversifying your money internationally, the most and one of the hidden asset classes out there is currency. So you're essentially, when you're buying an international fund from India, you're essentially buying two asset classes. One, you're buying some of the world's best companies, and second one you're buying is a USD, which I think is extremely important. When I went to school in the US around 10 years ago, I used to pay 40 rupees for a dollar. Today it's gone up to 75, 80, and it is expected to go to 100 in the next 3 to 5 years time. So essentially what and I think if I send my kids to the same school that I went 10 years ago, then I would have to pay 2.5 times more. So essentially what's happening is rupee depreciation has really cut our propensity to spend when it comes to our trips. And today, as you know, a lot of us are doing a lot more foreign trips. We are buying foreign goods and services. I think it's really important to have an allocation to not only international equity but to international currency, which is where this comes in. And if you look at history, you're looking at around 2 to 4% depreciation every year. So not only are you getting benefits of rupee depreciation and the returns from that, you're also getting benefits of the underlying stocks going up, as well as dividend yields, which I think are pretty high especially when it comes to the S&P 500. So these are some of the reasons to why I think investors should diversify. Investors should not only look at the US, they should also look at, I would say, Europe, and also look at places like China, Taiwan, Brazil, Korea, because I do believe that, a diversification should be global, not really US and India. So we do recommend looking at emerging markets and developed markets when it comes to your diversification. And as I said, it's the main reason to why you should diversify is not only to create wealth, but just to really make sure that your portfolio becomes a lot more stable, and you are sort of getting the impact of, I think, global business models and global wealth. So with that, thank you so much for this, and maybe we can open it up for some audience Q&A now. Thank you so much. So I have the first question. Are the US markets heading for a bloodbath with the rise of cases of the UK COVID-19 variant? So I think, with the vaccine coming in place and with most of the healthcare workers in the US being vaccinated, and also now they're doing this huge drive of vaccination, which is across the country. I don't think COVID or coronavirus is going to have a major impact on at least the US economy. The recovery in the US economy started happening at the peak of the crisis. In fact, just right before the peak of the crisis, you had elections, and post-elections is when you really saw the peak of the cases going up. So I do believe that, hopefully with the vaccine coming in place, you won't really see an impact on the equity markets. Recovery is strong and people have gone back to their daily lives. And I think surprisingly, because the US index, or at least the big companies, tend to be slightly more adaptable in the sense that most of them are tech companies, you won't really have the same impact as what you have in other countries where the dominant industries tend to be manufacturing or services. So I do feel that because of the way the US economy and the top companies are structured, they are pretty much, they will thrive in, I would say, this sort of a market when people are still working from home. So the next question is, can the revival of economic growth be stifled by logistical inconsistencies and political turbulences? So it's not a bad question. We've studied the last 20 or actually 25 elections, which is last 100 years. And we've seen, does a presidential impact have an effect on the equity returns in the economies? And what we've seen is that when there's a democratic sort of president, the returns are, I think, around 7 to 8%. But when you have a Republican candidate, the returns are exactly the same. So what that means is that, what we've seen is that obviously, I think my personal belief is that the president is obviously a very important figure, but he's essentially driving a big ship with a very small rudder. So the impact that at least on the equity markets tends to be quite stalemate. I think a lot depends on the underlying economic factors. I do believe that the US tends to be a hardcore capitalistic country, and regardless of which president comes in power, they need to lobby and they need to make sure that they are on board with all these large companies, because they really depend on it in terms of all the election spend. So I do believe that, I think, political and markets don't really have any correlation, and we don't really see any correlation going forward, especially in the US. So do you think valuations of stocks of Tesla and Amazon currently overpriced? I think it's a great question, and it's a very subjective question. I personally, I think that Amazon has been, I would say, pointed as overvalued for the last 15 to 20 years. I think Warren Buffett wanted to buy Amazon, I think 5 or 10 years ago, and they just gave the reason of valuations, and everyone's been talking about valuations. But essentially, I do believe that PE ratio is a very, to put it very lightly, it's not a very smart way of looking at valuations. It's a very lazy way of looking at valuations. I would say the true investors, look at something a little more robust, something called discount cash flow. And if you are able to foresee the future, just have more foresight on certain companies, and you see that, I think if you bought Amazon, even though it was expensive 5 years ago, would have been a great investment today because of how their businesses have transformed and how they managed to grow so quickly. So I think, yes, PE ratio tends to be very large, but you have to really see the long term or the big picture. Tesla obviously has so many plans out there, and obviously, if you look at the plans and the fact that like the founders managed to make all this true, if you look at the plans and if you look at executing those plans over the next 5 to 10 years time, then maybe the valuations are justified. But obviously, a lot depends on execution. So I do believe that yes, the tech sector is riding on very high expectations, and if they are able to deliver it, then it's great. But anywhere where they're not able to deliver, then that might be a problem. I think the big risk factor in tech sector is, I would say, political, where there is a lot of talk about monopoly, and there is also a lot of talk about I would say privacy. So those could be could be trigger points for the tech sector, but so far I think they've delivered, and I think they are riding on high expectations. So the next question is, what is your view on pound and USD currency? What levels can we look at by the end of the year? I'll be honest, I don't really look at. I don't know what the short-term future look like. I don't know what the world will look like 2 months from now, 4 months from now, 5 years, even 2 years from now. But I do know that we can expect, at least from an Indian context, rupee depreciation because of simple economics 101, where our inflation tends to be a lot higher than the US, and by that our interest rates tends to be a lot higher. So to keep things in parity, the rupee needs to depreciate by a certain amount every year. So yes, it is highly probable that over the long term the rupee will depreciate. But I'll be honest, I don't really have any comments to do with the pound or the USD. So that relationship. So there's a question on, there's a possibility of investing on margin trading as it is possible on global platform. This might be a technical question, but I'm actually not sure. So I think obviously, you should not. Number one rule is you should not do margin trading because unless you're doing it from a day-to-day perspective and you're taking intraday calls. But I actually don't know if you're able to do it on global platforms. There are several brokers that you can tie up with in India, which give you access to a broking account in the US, and then you can trade. But I think margin is a bit of a difficult thing because you obviously have to see, is the broker in the India providing margin or the broker in the US providing margin. US margin will be a lot cheaper, obviously, because the interest rates are much lower. But I think it might differ in the basis of what relationship you have with your broker. Yeah, so I would say, I think if you're looking at short-term trading, then essentially, if you had a choice, you should rather, I would say, take money from a US broker, but that would also require you posting collateral. So I think it's very specific to who you're broking with in the US. So GMO. So is the US market market in a bubble since similar to 1929? I think I think even Warren Buffett talked about this, about comparing today's sort of framework to 1929. And I do feel that I think the definition of a bubble is when no one knows it's a bubble. Everybody tends to come in at the same time, and that's when you sort of know it's a bubble. So the fact that people are pointing fingers that this might be a bubble is actually doesn't really qualify as a bubble. But essentially, yes, there are, as I said in my presentation earlier, there are high expectations riding on the top 20, 30 stocks, number one. Number two, valuations are, if you look at the DCF value, they are pricey, but you are looking at these companies, I think who are becoming a lot bigger. And I think there's a lot of innovation, and they're investing a huge amount in sort of innovation, which will make a big impact to our lives in the future. So, but at the same time, if you look at so yes, there are good earnings and good fundamental metrics, but at the same time, you have a lot of IPOs, you have a lot of SPACs that are coming out, you have a lot of speculation happening. So yes, there are, I would say, it's a weird stage where you have a lot of speculation and IPOs, and I would say a good definition of a bubble. At the same time, you have these companies who are posting great earnings. So I think you could be in a bubble, but obviously the problem with a bubble is that no one can time a bubble. So even if you sell a stock today, you might have another run up for another 20, 30, 40%. So I think better to just stay on the path and stay invested for the long term.
Wow. Thank you so much, Prateek. That was a really comprehensive and insightful session on the US market. Thank you so much.
Yeah, thank you.
Ladies and gentlemen, we now open up our third and final poll for the day. Let's see what you've taken away from Prateek's session, because our poll asks you whether you would be willing to invest in the US market at current valuations. So please do take that poll. Now, coming to our next session. If you've noticed, a common theme emerging from some of our recent sessions has been disruptive technology. And why just our sessions? New and emerging technology has become an increasingly integrated part of our lives in this past year. The question is, how do we benefit from it? Tan De Jin, Senior Equity Analyst from iFast Financial Singapore, is here to tell us what lies ahead for the digital economy in 2021. Welcome, Tan De Jin.
Hi, Deepali. Thanks for the introduction. So good afternoon, everyone. My name is De Jun. I'm a Senior Equity Analyst here at iFast Singapore, and today I will be sharing with you about the digital economy, the impact COVID-19 has had on it, and more importantly, the investment opportunities that we see over the next couple of years. So without further ado, let's begin. So right now, the world as we know it is on the cusp of a new technological revolution known as the Fourth Industrial Revolution. So this marks the turning point in human history where the widespread use of digital technology such as the internet is blurring the lines between the physical and the digital world, forever changing the way we live, work, and interact with one another. But unlike the previous three industrial revolutions, the digital technologies today, they are evolving at such breakneck speeds that businesses and individuals alike are finding it hard to keep up with the changes at times. And those who fall behind run the risk of being rendered obsolete. The rapid digital transformations across all industries and sectors will bring about many new investment opportunities, particularly among companies that are able to adapt to the changes quickly. And as the world we live in becomes increasingly digitalized, the digital economy will become an integral part of every investor's portfolio. So what exactly is the digital economy? The digital economy can be defined as a massive web of interconnected stakeholders and supply chains covering all digital products and services that are enabled by the internet and other digital technologies. So while there is a lack of an industry classification system due to its complex nature, the digital economy can be broadly categorized into the following 8 categories, as you can see on the screen over here. So let's talk about some of them. So e-commerce, for instance, has fundamentally transformed the way people shop for physical goods, with e-commerce companies like Amazon and Alibaba in China having an outsized impact on the broader retail market. And as more people choose to shop online, brick and mortar retailers are forced to reinvent themselves to get ready for the digital era. So another segment of the digital economy is cloud services. So cloud services is one of the fastest growing segments, and this is where cloud service providers, they actually provide the hardware and the software that are needed to support the data storage, computing, and networking requirements of a business. And as more companies migrate a greater portion of their workloads onto the cloud computing industry is set to see explosive growth ahead. So let's talk about one more, that digital advertising. So because consumers are spending an increasing amount of time on the internet compared to traditional media, engaging with them is no longer the same as before. So for firms who are looking to advertise their products and services, digital advertising is almost always a necessity to maintain a strong online presence. So collectively, these 8 segments that you see over here, they make up, they are worth approximately $9.5 trillion today. And that's roughly 10% of the world's GDP. So if you were to think of the digital economy as a national economy, then the digital economy would be the 3rd largest in the world, only behind US and China. So taking a look at the changes in the world's largest companies across time will give us a sense of how quickly the digital economy has developed over the years. So compared to a decade ago, when only 2 of the top 5 companies are considered digital economy stocks, every single one of the top 5 companies that exist today, they belong to the digital economy. And looking ahead, we think that the digital economy still has plenty of room for further growth in spite of the disruption caused by COVID-19. So while we're on the topic of COVID-19, I think it's safe to say that COVID-19 has caused a lot of stress on our lives, but at the same time, it has also revealed the importance of digital readiness. So during this period, companies that have performed well, they are generally those that have an established digital presence, while those that don't typically do not. So COVID-19, it has had a disproportionate impact on various sectors of the economy, with some more badly affected than others. But in the case of the digital economy, we believe that COVID-19 is actually an unexpected catalyst, one that will likely produce a net positive impact in the long run. So the global health crisis, it has brought about many structural changes to the way we live and work, and with most countries implementing social distancing measures to stem the spread of the virus, physical in-person activities have gradually shifted online, and this has also driven up demand for digital services such as e-commerce, cloud computing, and even digital payments. So within the digital economy itself, the cloud services segment has been one of the biggest beneficiaries of the pandemic. The 3 largest cloud service providers in the world, which are Amazon, Microsoft, and Google, they have all reported significant growth in cloud revenue as companies invest heavily in digital infrastructure so that their employees can continue to work remotely during this period. And the positive impact of the heightened demand for cloud services has also spilled over to other segments of the tech sector, such as the semiconductor industry, for instance, where demand for data center chips has been growing rapidly. So besides cloud services, online consumption has also benefited from the pandemic. So take China, for instance, which endured one of the strictest lockdowns in the early days of the pandemic, has seen the sharpest rise in e-commerce sales since 2014, as online sales accounted for roughly 25.2% of the total retail sales in China over the first half of the year, which is nearly 5 percentage points higher than where it ended the year in 2019. And besides e-commerce, online consumption of services also saw an uptick across 2020. And in the latest quarterly update, Chinese food delivery giant Meituan Dianping, they revealed that the transaction volume for its food delivery segment actually surged to a record high of about 152 million renminbi. And that is approximately 35% higher than its previous record high of 112 billion set in 4Q19, which is just before the pandemic hit. And this is mainly due to the steady increase in the number of users and order volume as consumers begin to appreciate the convenience of food delivery services. The growing demand and popularity of food delivery services has also prompted many merchants to partner up with the company, as the company has onboarded nearly 500,000 new merchants over the first 9 months of 2020. So over here, these are just two of the many examples of how businesses have accelerated the adoption of digital technology in the wake of the pandemic. And as we head into the post-pandemic years, we foresee that this trend will continue as businesses make preparations for the next crisis and also to remain competitive in a digitalized world. So as a matter of fact, we are already beginning to experience some of the positive impact that the pandemic has on the digital economy, as the share price of OGIG, which is our recommended ETF for this sector, has more than doubled in 2020. So this is in stark contrast to the performance of broader equity markets such as the STI or even the S&P 500, for instance, which has delivered gains of only about 15% in 2020. And with that being said, investors who have held on to this ETF for the better part of 2020 would have likely made some decent profits already, and you may want to consider taking some profits off the table. However, we do caution against selling out completely. So the reason for this is that when it comes to portfolio construction, asset allocation, it should always reflect economic reality. And the reality is that going forward, internet companies will make up a larger part of the global economy as the world we live in becomes increasingly digitalized. And this is the fundamental reason why we recommend that investors include the digital economy as part of their core allocation when they are constructing their portfolios. So looking forward, even though valuations of several digital economy stocks may seem a little stretched at this point in time, we note that the long-term outlook of the digital economy remains robust, and the industry is expected to deliver earnings growth, supported by rising internet adoption rates and widespread digital disruption. So let's talk about some of these mega trends, starting with the rising internet adoption rates. So despite expanding at an exponential pace over in the recent years, global internet usage remains far from saturated. And the number of internet users worldwide currently represents about 60% of the total global population, which means that there is still a large number of people who do not have access to the internet. And across the world, it is for sure that there are vast differences in the maturity and the extent of internet services that are available in each region. So developed regions such as North America and Europe, for instance, are nearing saturation with penetration rates as high as 95%. However, the penetration rate in Asia remains relatively low compared to developed markets. So this is despite the fact that Asian economies, they have a combined population of exceeding 4 billion, which accounts for more than half the global population. And as internet penetration rate in Asia converges with developed markets, the digital economy is likely to see promising growth over the next few years, with internet companies being the main beneficiaries. Besides the rising internet adoption rates, another mega trend which we think will contribute to the growth of the digital economy is the widespread digital disruption. So digital disruption is a transformation that is caused by emerging digital technologies and business model. And this in turn is caused by structural shifts in consumer habits, such as the shift from offline to online. And as people begin to spend more time online, digitalization has become a necessity for businesses that wish to remain competitive in this new global backdrop. And to stay ahead of the competition, companies across all industries and sectors have been adopting digital solutions as an alternative source of revenue and also as a way to improve efficiency. So e-commerce is one good example of this. So compared to the past, many brick and mortar stores today are gradually turning towards e-commerce, which vastly broadens their reach. And in 2019, worldwide e-commerce sales hit a record high of 3.5 trillion US dollars, the majority of which came from China, which is currently the largest e-commerce market in the world. So over there, companies like Alibaba, JD, and Pinduoduo, they control about the majority of the e-commerce market. And if you look over to the West, the US is actually the second largest e-commerce market in the world. And over there, it is no surprise that Amazon is the largest player with a market share of over 50%. And the global e-commerce market is estimated to grow at a compound annual growth rate of about 17% over the next 3 years and reach a value of 6.5 trillion US dollars by the year 2023. So all in all, we think that as these megatrends begin to unfold, demand for digital products and services will rise, and so will the earnings of these companies. Now, how should you invest in the digital economy? So investors who do not have exposure but are keen to invest in the digital economy at this point in time, you may want to consider using a systematic investment plan before switching to a lump sum investment should the opportunity present itself. So this will ensure that you buy more units when prices are low and less units when prices are high, which will bring your weighted average cost down. And I think I've already mentioned this earlier, but our recommended product for exposure to the digital economy is actually the O-Shares Global Internet Giants ETF. So this ETF is US listed, and it's the ticker is OGIG. So this ETF is actually a rules-based ETF that is designed to provide investors with exposure to some of the largest global internet companies that derive most of their revenue from the digital economy. So companies that are included in this index, they must exhibit quality and growth factors. And in terms of country allocation, 61% of the companies inside this ETF are from the US, 21% from China, and the remainder from the rest of the world. And so moving on to some of the holdings of this ETF. So the top 10 holdings include the likes of many internet giants like Amazon, Tencent, Microsoft, so on and so forth. So overall, we think that this ETF is actually one of the best in the market for investors who are seeking exposure to the global digital economy. And since inception, OGIG has actually delivered returns of more than 100% across 2020 already. And with the structural tailwinds behind the digital economy, such as your rising internet adoption rates, as well as your widespread digital disruption, and also the fact that the world itself is becoming increasingly digitalized and tech-driven, we are confident that OGIG will continue to perform in the long run. And I think with that, I've come to the end of my presentation today. So I hope that through this session, you have been able to gain a better understanding of the digital economy, its prospects, and most importantly, why we are so positive on this sector. So once again, my name is Jun. Thank you all for being here today, and I wish you all the best in your investment journey.
Thank you so much for your session, Jun. We do have a couple of audience questions. Would you be open to responding to them?
Sure, let's take a few.
Okay. Can we have the questions, please? Yes.
Okay, so the question is, with excess money being printed in the US and mail order checks coming in, do you feel that there's a correction looming in the US index? So I think that it is no secret that valuations in the US, especially for some of the tech stocks, they are near all-time highs. But the thing is, as investors, we should always be forward-looking. And what I mean by that is, whenever we buy a stock, we don't buy it for the earnings that the company has already delivered in the past. We buy it for what the company can deliver in the future. That's what I mean by forward-looking. So even though valuations might seem a little high, if we stretch our horizon out a little further, perhaps 2 years, 3 years, or 5 years if you can see that the earnings growth is actually substantial, and it will bring valuations a lot more reasonable. And so I think that unlike the past, like in 2008 or 2001, valuations are stretched. But at this point in time, this year, the higher valuations, the higher prices are actually supported by earnings growth. So yeah, I think that the US, the US index, the US companies, they should continue performing well. So the next question is, does the digital economy bring a large amount of volatility and uncertainty that would disrupt our portfolio? So I think the short answer to this question is yes, because like I've shown you earlier, inside this OGIG ETF, you have some of the largest tech companies, Meituan, Alibaba, Microsoft, Amazon, and some of these companies, they are known for very volatile price movements throughout the day. So you can expect to see some, if you include the digital economy inside your portfolio, you should expect to see higher volatility. However, I would like to remind investors to focus on the long-term growth story of the digital economy. And that is mainly driven by the fact that the world we live in today, it is becoming really increasingly digitalized. Every day we interact with technology from the moment we wake up and the moment we go to sleep. And for companies that are leaders in their own segments, we think that they will continue to do well as demand for their products and services is still robust.
Thank you again for answering those questions for us, Vijay.
You're welcome.
All right, bye-bye. Can we now see the responses to our third poll, please? We asked all of you if you would be willing to invest in the US markets given its current valuation. But rather than answer this question myself, I'd like to bring on our panel of experts who are here to answer this very same question. I present to you, ladies and gentlemen, Mo Hon Meng, co-founder of iFast Corporation and the moderator for this panel, Gavin Marriott, Investment Director with Schroders PLC and our keynote speaker, Prateek Oswal, Head of Passive Investing at Motilal Oswal Asset Management, and Pyari Menon, Assistant Vice President and Institutional Portfolio Manager at Franklin Templeton India Asset Management Private Limited. Welcome all, gentlemen, and over to you, Hon Meng.
Okay, thank you, Deepali. Good evening, everyone. I'd like to thank my panel members whom Deepali has just introduced. Thank you for participating in this panel. Actually, a lot of the questions I prepared have already been addressed by Gavin and Prateek in your speeches, as well as the questions that followed. And I think just now with Derchin as well, some of the questions were asked. I think people are generally very worried about the bubble or rather valuations in the US, whether there's a bubble or not. So I guess I'm going to ask questions slightly differently, and I'm going to invite the audience to pose the questions. So I'll leave some time for questions so that we can address a wider range of issues. Okay, the first question I have for the panelists is maybe a theoretical one. So if I forced you, if I told you that you could only invest 100% of your money for the next 10 years in either the US market or the Indian market, okay, completely all your money in the US or all your money in India, which would you choose and why? Let's start with Prateek.
Thanks. Yeah, thanks. That's a very interesting question. I do believe that it's important as a philosophy to invest in what you understand, and I think especially coming from my perspective, I think the Indian market is a lot closer to me. I understand the market a lot better. I understand the economics, the macro fundamentals, and also the sort of opportunity that exists in India today. So I would obviously choose India. I've always maintained that it's always really important to have global diversification, to have global themes in a portfolio. But for me, that's more of a diversification theme as opposed to an investment theme. So I would stick to India because of what I know about and because I'm right here.
All right. And so, Gavin, all your money in India as well?
Mm-hmm. Yeah. So much a theoretical question, actually, because personally I have exposure both to India directly and also the US, largely through global and thematic plays. If you were to ask me though which one I would choose, it probably would be 100% to the US market. And the reason for that is twofold. First of all, I think investing in the US, you get broad international exposure to multiple sources of revenue. So around 40% of the US index derives its revenues from the local economy, meaning 60% is derived internationally. And unlike India, where I think about 70% is derived from the local economy, that just gives me a more diversification within my portfolio. So I think that is primarily the reason. The second is you get a much broader spread of sector exposure, albeit there is a significant skew to tech.
Okay, thank you. And Piari?
Yeah, so I think both the panelists have covered the primary things, but I'll just make one point with respect very specifically about the market, which is it is a developed market, but it has a lot of emerging market characteristics. And what I mean by that is, the growth rate which you see is slightly better than most of the developed markets. And the reason is a lot of trends, it's in technology, or whether it's in healthcare, even in consumer, actually originate there. So one of the markets where, definitely should, I think, diversify, whether you're in India or wherever. So that's one of the huge benefits which I think investing in the US might have. But look, end of the day, the theoretical question if you have covered all your liabilities and have significant extra already there in India, it would any spare beyond your few years of liabilities, I would invest in you to get exposure to diversification. I think one of the benefits, which I'm just putting a simple number, is India is 1 billion people. But the per capita income of developed markets is 55 times ours. So, if an Indian, when he's got an opportunity, does the other markets, he's making huge mistake. That's the way I look at it.
Okay, thank you. So the second question really relates to this question about valuation that everybody's concerned with. But I thought another way to ask that question may be, what are you doing with your money? Are you right now adding to the US, or are you reducing from the US? Let's start with Kevin.
With my personal money or within our global portfolio?
With your personal money.
Oh, I'm very boring. My asset allocation doesn't change dramatically, so I'm just prepared to let my exposures run on the basis I'm taking a medium to long term view. So, I clearly allocate more to the US than I do India, but that's simply because of an expectation on return. I think between two markets. If I were to manage my personal portfolio tactically, I would probably be adding to the US despite valuation.
Okay, adding to the US, interesting. Let's go to Piari. At this moment, would you be adding to the US or reducing from the US?
Yeah, no, to hold whatever I have for the simple reason, I think, I agree that, the stock bubble is gaining steam, but it's something that's been going on over the last 10, 11 years. Even in 2009, market fast. And so long as there are enough players, I think we are in a reasonable kind of safe territory. It's not to say that the signs of a bubble, but I was reading a McKinsey piece that they had put, which used a they called it the rational bubble. And genuinely around the world, there is be pockets of business that is happening. There'll be some hot stocks and you just can't do anything about it. But if you look at it, the market has been very odd. Stocks that have done very well have been sectors and the stocks which have blown the earnings out. And if you look even in geographies, I think one of the things, I know it is a US discussion, Europe is still not beyond the 2000 peaks. So for the last 10 years, The market has just not moved in US, in Europe. So the market allocation, and these days the liquidity that is being pumped in basically just finds its way to wherever it wants to go. So the market has been very discerning in a kind of pushing up these things. I agree there are enough kind of when the liquid rises up, there will be a problem. The way I look at it is, despite the valuations being so high and yields now going up, I think the tiebreaker is, are we in a bull market or not? And as you know, that is my bias. I think we are in a bull market. There are some signs of, but it is, and there are some. I mean, as you will have always some eye-popping stories about huge run-ups, but I still think that a lot of movement of the major stocks have been actually for legitimate reasons. Yeah, just not an accident. That's the look at the market as it is now.
Right. So, Pratik, your personal money, are you adding or reducing from the US?
Yeah, so I've been adding for some time now, so I think unfortunately, I think me as well as I think most of the investors in India are heavily underpenetrated towards I would say global equities. So I think I would, and I'm still recommending, I would say, investors to add on to their portfolios. The only difference I would do is to not really do a huge lump sum. I think I think dollar cost averaging can really help out in a very big way, because it really minimizes any volatility that comes with any investing. So even if you started, say, doing a dollar cost averaging at the peak of the tech bubble or the peak of the housing bubble, I think you should be fine, because of it really averages out your sort of performance over time. So I think it's important, because as a country, most investors are thoroughly underpenetrated towards their ideal asset allocation. So I do believe that you should ideally add on to your US book, but obviously I think I would also recommend it doing slowly, which is what I've been doing.
Okay, well, there you have it, ladies and gentlemen. All three of our panelists would be adding to the US rather than reducing. So I think that's an interesting answer to whether they think there is a bubble in the US or not. I think they clearly think that there are still opportunities, and it's not a time to be avoiding it altogether. Okay, let's go on to the next question. And this has to do with this famous debate on whether active is better or passive is better. So, I mean, with valuations being stretched, if you invest passively in, say, the S&P 500 index, you can't do anything, right? Currently, I think you have Tesla at number 6. I mean, it's the 6th largest stock in the S&P 500. It has a higher weightage than Berkshire Hathaway. So, but then if you bought S&P 500, you have no choice, right? You just have to buy into the proportion, the weightage that's there. So some say it's a good time to be buying actively managed funds, because the fund managers can then choose stocks that are better value, or stocks that are poised to recover even better after COVID. So what are the panelists' opinion in terms of whether it's at this current moment, active is better or passive? Whether active has a bigger role to play than passive. Let's start with Pierre.
Yeah. So the word which I think you're talking about is the passives will be forced to own stocks which seem to be overvalued, irrespective of that the portfolio manager wants it or not. But I mean, the way the passives was every day, whatever inflow or outflow they have, they keep rebalancing what their position is. And so that is one of the things that they automatically do. So it's not going to be that big over a period of time that's going to happen. And if on average, whether it's a down year or an up year, roughly somewhere between 20 to 35% managers beat the passives. But otherwise, the passives, most of the passives outperform more managers. That is 20 to 35% of active kind of mentioned. Very few do it on a consistent basis, but there are some who do reasonably consistent. If you can find them, I think you should go for the active manager. But the next point is, the advantages actives may have is most of us keep some cash on the side for a rainy day or for redemptions, which I think most of us don't. But that's a small amount. Typically, it's about 5%. Even a decent move, it's not going to have such an impact. But I think to get to I think one of the things in terms of valuations which have looked at it just in terms of how much money flow has been getting allocated. So so if I look at S&P and if I look at NASDAQ, for every dollar over the last 10 years, 20 cents went to the FANGs, the top five names. I won't say just FANGs, but Microsoft. So depending on which, is roughly about 20 plus cents went. And to the NASDAQ passive, almost 40 cents. So that was driving up the momentum. So now I think FANGs plus Microsoft it might be 22, 23 kind of percentage. So when that goes out is basically what it is. And small percentages move there to exaggerated impact. At the same time, I think if I look at the top 5 2020 top holdings, there have been names which have gone out passive because they dropped out and somebody else was setting the price. But the passives have still done very well. So you don't have Chevron, you don't have Exxon, and I think GE was another one. All of these are out of the top 5, but passives are still fun. So I think it is a case of trying to figure out which fund manager you want to invest in if you're good with the active. But people, I think the passives do okay if even in this kind of situation. I think it will still continue to remain this 30% of the people beating the market. But yeah, I think passive is a good way to kind of save on some fees, which over will pay you. I don't know if I answered the question. That's basically the way I would kind of look at it.
Yeah, yes, I think you did. So let's go over to Pratik. Sorry, there was a bit of a lag. Yeah, well, let's go over to Pratik.
Okay. Yeah, so it's I think the way I see it, obviously, I mean, I might be biased towards passives because we are as an AMC selling passive funds in India. But essentially, what we've seen is that obviously the debate between passive and active has been quite, I think, heating up in India as well. But it's pretty much still 50-50. But when you look at the more developed markets such as the US or maybe Europe or even other markets, I think you do see that over a long enough time span, you do see significant amount of outperformance in most of these passive funds. So essentially, I think yes, in the order of simplicity, if someone does not have the time bandwidth to go out there and select the right funds in their portfolio or right active funds, then I think passive funds make it super easy for you to invest in and also get equity exposure in general. I also feel that, for someone who's looking at it from a very long-term perspective, say, for example, the S&P 500 has been around for almost half a century. And not only has it really thrived, but it's actually, I think, managed to survive over that entire lifespan. So I do think that, people who are looking at a decision when it comes to, say, just diversification, then you could keep it super simple and just invest in an S&P 500. Or if you want a higher allocation towards the techs, then you can obviously go to NASDAQ. Or, I mean, there's tons of options. Even if you think that you are obviously do not want to be top heavy, you always have themes such as small cap value or a small cap index where you can obviously play around with the rest of the sort of equity landscape. So I do feel that for simplicity purposes, I do feel that passive works out really well. But if there are investors who are looking at alternative themes, so for example, disruptive innovation has now become a big theme on the back of really good performance over some of these technology indices. So yes, if there are investors who are taking a bet on certain themes or certain strategies, then I would say that active obviously makes a lot more sense. Or they could sort of add it as one of the funds in their active portfolio. But overall, I think to keep it simple for someone sitting in India, I think it's a very simple thing to go for like a simple index fund that's giving you exposure in broader markets.
Okay, thanks. Gavin?
I'm probably going to surprise you and agree actually that there is definitely a role for passive management. I use passive exposure within my personal portfolio, particularly where I'm just looking to maybe add tactical exposure to an area of the market or a region on a short-term basis, and I'm going to trade that. So I think there passive has a role because it's a cheap way of obtaining market beta. In a context of longer-term allocation, I think there is again a role for both. I clearly would favour active management, and I don't think that decision changes by geography. So many people would argue that the US is a very efficient market and therefore active management can't add value. I sort of would push back on that because the inefficiency in the market, in the US market, is as strong today as at any time in the past 30 years, in my opinion. The market will overreact to short-term data. It fails to look far enough ahead in terms of understanding some of these themes. And if you have an active manager, I think you can do very well. So horse for courses, but I think in the context of US equities on a long-term basis, playing some of the themes and being sensitive to some of the valuation excesses at the moment, I would definitely take an active.
Oh, interesting. So both Pratik and Gavin said that you could use passives for this tactical investments in the US. So could you share one idea that you are currently invested in or looking to invest in? One tactical idea that you like. Let's go. Let's start with Gavin.
Thanks. Well, the way I'm using passive at the moment in my personal portfolio is to increase my exposure to European equities, and I do that via a Vanguard ETF, and that simply reflects a positive view about global economic recovery. Europe is, much more heavily orientated to that cyclical recovery, and I just want to add a bit more exposure in that particular area. So that's something that I've done in recent months, an example of how I use passive.
Okay, Pratik.
Yes. So,
sorry, Pratik. Just before you answer, maybe I just prepared the audience. Just after Pratik's answer, we'll be taking a couple of questions from the audience. So do send in your questions. Thanks. Okay, over to you, Pratik.
Yeah, thanks. I would also sort of have a very similar answer to what Gavin had. Essentially, I think a lot of people are just talking about the US and the US only, but we're looking at a broad recovery. We'll also be looking at Europe. You look at markets in the EU and as well as Japan, as well as emerging markets like China, Taiwan, Brazil, Korea. So I do feel that I think investors today are. I remember in 2008 when I was in college, when everybody was just investing in emerging markets and nothing else. And today it's the exact opposite scenario. So I do feel that I think everyone who's looking at investing should ideally have a more broad-based approach towards investing, and should also be looking at like the EU, Japan, and also emerging markets, which I do feel is going to have an incredible recovery this decade, because last decade was not really that great.
So sorry. So your one tactical idea is?
I would say like a if I could choose, I would do an emerging market strategy.
Right. Yeah. Right. Yeah. Okay. Cool. Okay. Let's go to some audience questions. Okay. The Chinese are trying to push the West with their own protocols changes to technological standards. How will the world evolve out of the biggest tech battle of the century between these two countries, and how will it impact investors? Any of you have a strong view on China? Maybe I start with you, Gavin, since you're global manager.
Yeah, no, it's a very relevant question, and that's surprising actually is the amount of exposure to tech-related industries you get through an investment in China. I mean, in the US, if you looked at tech-related businesses, the IT sector plus any tech-related industries, you probably have around 35 to 40% exposure to that area within a US index. In China, you're probably pushing 30% already today, and clearly there is a strong focus in terms of innovation in that country. So I think from an investment perspective, it's just to be aware that there is another game in town. It's not just a focus on the established US tech providers that have dominated the market for many years. The emerging technology providers in China, I think now are very credible alternatives. It introduces a whole raft of additional competition, and it will have implications in terms of the margins and the financial characteristics of the tech industry more generally. It introduces healthy competition and some disruptive competition as well.
So what should an investor do?
Well, I think again, it's just to be aware of companies' competitive moats, the extent to which proprietary technologies can be maintained, and to what extent there is the potential for competitive risk that could disrupt the growth that you're modeling into your to your financial models. We look at some of the established tech players today, and we look at the valuations, at which are in many respects assuming that competitive advantage, current margins can be sustained for 25, 30, 35 years. And in tech fast-moving pace, it's unrealistic to think that a company can sustain that level of advantage and pricing advantage over a 15, 20-year time horizon.
Okay, I'm just gonna direct one question to each of you, unless you feel very passionate about the question. So just speak up if you do. Let's go to the next question. Economic divide is poised to significantly widen further in India. What do you think the Indian law policy makers do differently to accommodate equitable growth going forward? Okay, so I'm gonna direct this to Pratik, who has all his money in India. No, no, not all. I mean, in that theoretical question, but to you, Pratik.
Yeah, I think it's a very important question because if you look at India today, it's a lot more, I would say, divided in terms of the economic landscape than what it used to be, say, 10, 15 years ago. But I also think that in India, unlike other markets, more developed markets, there is some bit of trickle down effect that you see in India, and you've seen that over the last 20, 30 years. That you have seen a lot of the the upcoming middle class, which has now become a huge part of India. So I do feel that India is now sort of I think a lot of India is still sort of not really evolved in the last 10, maybe last 20 years, but I would say a good proportion of it is sort of I would say middle and upper middle. So I do feel that yes, the divide is still there, but it has I would say not as steep as what it used to be a few decades ago. And I do feel that the government is pushing its agenda. I do feel that education itself is a huge requirement in India, and that's already pushed a lot of people out of poverty in India. And if you look at the statistics of poverty in India versus what it used to be, it's a lot lower than it's there. So I think number one, I think a lot of entrepreneurship in India is going to really help build newer companies, which will obviously expand I would say the entire sort of population in terms of employment. The second is, and this is the most important point, is the average age. India is a pretty young country, so obviously and the gross productivity of India will increase a lot more as these people leave colleges and go and I would say work in companies. So I think a big challenge today, the way I see it, is how do we employ these millions and millions of people who are coming out from Indian colleges on a yearly basis. So that is going to be a huge challenge. And if the government's is managing to ensure that employment is low and these hundreds of millions of people who are coming out of colleges and are getting good roles, then you can expect a lot more equitable India going forward.
Okay, good. So let's do one last question and then we can wrap. Is it good to invest in crypto shares like MSTR? Well, Pierre, you got that question. You give it a shot. Pierre?
Hello?
Yeah. Okay, I can hear you now.
Yeah, okay, sorry. So, I mean, I don't have any cryptocurrency positions at all. And for the simple reason, I think it goes back to what Pratik first said. I've just not figured out, what it really means. It's not a currency because it's not very liquid. I cannot do any transactions. It's not an asset in the sense it creates any cash flows for me. It doesn't even have the value like an artwork or something will have. So I just can't figure out what it really is. The benefits of this is, either way I look at, the only reason I kind of this is something called the Harry Potter effect, where Potter books started to have strong sales. Books also started to have strong sales because people went to the shops to buy. And whenever the cryptocurrencies have been having a run, I think what you see in the markets also run. I don't think there's some kind of a hedge on the markets because it has been pretty driven. So it is just you're going along for the ride. So recently you've banks talk about it, and you've seen even I think Janet Yellen talking about it recently. So I just can't make sense of it. At some stage maybe this will become something that is very, very important, but I don't know how to play it. But there have been companies which have made a lot of money. Similar companies, to give examples, we're talking not mistaken Taiwan company TSI and these kind of people, because Nvidia claims about almost 7-8 of their the graphics chips that is actually going into mining for these things. So there is ecosystem being formed around it, and I'm sure that there will be be there in some form or the other 5, 10, 20 years down the line, but I just haven't got my head around it.
Okay, quick yes or no question. Pratik, got cryptocurrency of any kind?
Sorry, could you repeat that, please?
Quick yes or no question. Do you have crypto of any kind?
I do.
Okay, Gavin, do you have yes or no?
No, but I think I probably will have in 5 years' time.
Oh, no? Okay, interesting. Pierre doesn't have. Pratik has. And Gavin, no, but he will probably be buying soon. So that's something that I'll leave the audience with. I'm told there are over 650 audience members at this time. So 600 people thanking you guys for all your answers. I hope it has been insightful to all the audience members. Thank you. Back to you, Deepali.
Thank you so much, gentlemen, for such an interesting conversation. You guys are certainly having fun and the energy showed. Thank you again for joining us. It's now time, ladies and gentlemen, for a short break before we meet again for the breakout sessions at 6:30 p.m. We had promised you direct access to some of the leading names from asset management in India, and here they are. We have 3 breakout sessions scheduled for 6:30 p.m. today. The first one is on asset allocation in a global investing scenario. This session will be held by Mr. Vikash Wadekar, who's head of sales with Motilal Oswal Asset Management. The second session is on advisor value add by Franklin Templeton India Asset Management Private Limited. This session will be held by Mr. Pesi Dastoor, who's the National Sales Director. And the last breakout session, the third one, is going to be held by iFAST Financial India which is going to address how mutual fund distributors and advisors can position their business to grow in today's regulatory landscape. A lot of interesting choices, guys. This is a good problem to have. So please do join them at 6:30 p.m. Now, before we log off for our break, I'd also like to announce that all of you lucky people who won an invite to our exclusive masterclass today will receive your invitations anytime now. Please log in sharp at 8 p.m. for your masterclass with Sarah Grillo. I would also like to highlight again that all of our speaker presentations and a lot of other interesting material on products we discussed today will be available via the sponsor exhibits. When you go into the lobby, you can access the sponsor exhibit room, and within that, you will find all the sponsor exhibit booths. So please do make use of all the interesting collateral posted there. And finally, I would just like to highlight what we're going to do tomorrow. As I mentioned earlier, we're covering the emerging markets as well as other developed markets like Japan and Europe. With respect to emerging markets, I'm looking forward to a very interesting panel discussion because as Indians, we all wonder that with our markets being as exciting as they are, do we really need to invest in other emerging markets? So please sign in again tomorrow for this panel discussion to find out what our experts have to say. See you all at 6:30 for the breakout session. Thank you.